All right, so in this video, we're going to go over amortization of loans, okay? Most loans that are amortized are mortgages, are the big one, the most common one. And you'll notice in the website here, I'm using bankrate.com. You can just search bankrate.com amortization calculator, and this link will come up, okay? It says mortgages in the link, but that's really not a huge deal. It can be mortgages, it can be car loans, it can be personal loans. Any number of loans like that could be what we call amortized, okay? And we're going to learn about the amortization schedule and what exactly that means, okay? So when you amortize a loan, it can be called an installment loan, okay? You make equal payments each month, okay? Part of that payment will go toward the principal, and the other part will go toward the interest, okay? As the monthly payments move forward, more money will go towards principal. In the beginning, you're paying more interest. In the end, that interest is decreasing with each payment, and you're paying more towards the principal. Okay? The schedule is usually provided to you by whoever's financing your loan, whether it's a bank or a financing company. Okay, you'll be able to see that amortization schedule, or you can use this website and figure that out, okay? All right, so let's say we want to borrow $5,000 to buy a car, okay? Now, when you buy a used car, you don't want to finance for as long of a time, okay? Because, if the car breaks down, you're still making payments. That's not the best thing. So let's say we're going to finance this over 3 years, okay, which is 36 payments, okay? And let's say your credit score is not very good, okay? So let's say the interest rate is like 7.5%, okay? So when we hit calculate here, it's going to tell us what the monthly payment is, all right? And it's $155.53, all right? You can see here the principal paid is the amount you borrowed. You borrowed $5,000, so you're going to pay $5,000 back over the life of the loan. The total interest paid here, this is assuming you make the monthly payment each month and nothing extra. Okay, you don't miss any payments, but you don't pay any extra either. Okay, so you're making 36 equal payments of $155.53. Well, if that's the case, you're going to pay almost $600 in interest over this 3 years. Okay, and that's how the bank makes money, is charging you interest on loans. Okay, so down here we're going to click on Show Amortization Schedule. Let's take a look at what happens here. So we're starting this loan on January 4th, 2022. It's a 3-year loan, so the estimated payoff date would be January 4th, 3 years from now. Okay. Notice you don't make your first payment until February. That's pretty common with car loans. You buy the car, your first payment's not due until the next month. Okay. So again, notice each monthly payment, down this first column, it's always the same, that $155.53. Okay. But also notice the principal and interest relationship here. You're paying the most interest early in the loan, okay? Starting at $31.25 and decreasing slightly over those 36 months, okay? Your principal on your first payment is the lowest amount you're going to pay in principal each month. And notice that it steadily increases as you make more and more payments, okay? The reason this happens is the bank, wants to get their money. They're making the loan to you. They want to make sure they get as much of that interest as possible. So earlier in the loan, you're paying more towards that interest, and that decreases over time. Okay? This column, notice is total interest. It's just the total amount of interest you paid up to date when that monthly payment is made. Okay? So if you'll notice, after the first payment, you've obviously paid $31.25. Well, after 2 payments, you've paid $31.25. You paid $30.47. Add those together and you get $61.72, okay? So over the life of the loan, you're going to see this number increase to that value of $599.12, okay? And the last column is the balance. This is your principal balance, okay? So it starts at $5,000, and we're gonna take away the amount that was paid towards principal with each of these payments, okay? All right, so if you scroll down here to the bottom, you'll see that in January of 2025, you'll have a balance of 0. You will have paid that $599.12 in interest, okay? And in total, you will have paid almost $5,600 for that car, okay? Now, there are ways to decrease the amount of interest you pay. We're scrolling back up here. Okay, add extra payments. So let's say, you like nice round numbers. So let's say we want to, add another $25, or let's say another $50, okay, on each payment. So let's add $50 to each payment because we want to decrease the amount of interest paid, okay? Again, notice it says mortgage, but that works for car loans as well. So we're going to apply those payments. All right. And you'll see that your payment is now $205.53 each month, okay? Look at the estimated payoff date. Originally, it was January of 2025, okay? By us paying an extra $50 each month, we sped that up. It's like 9 months quicker that we're paying this loan off. So instead of being 36 months, it's going to be, about 27 months, a little over 2 years, okay? So initially, we were paying almost $600 in interest. By paying an extra $50 each month, we're saving ourselves about $160 total in interest, okay? And you can play around with this calculator and see, how much extra can I pay to decrease. If I want to save a set amount of interest, you can play around with the calculator and see what's best for you, okay? So that's how you use this amortization calculator. That's how amortization works. You're going to see a lot of these amortization schedules in your life. Anytime you buy a car, anytime you take out a personal loan, and the big one is when you take out a mortgage to buy your first house, you're going to definitely want to look at the amortization schedule to see what your monthly payment is, how much is going to interest, and how long it's going to take you to pay off.